Hi, folks. It's great to see everyone here. That was darn slick. That was the first time we had all seen that. Wow. Very, very impressive. So thank you to, someone out there that put that together. It's really great to welcome everyone to Palm Beach. We have a lot of stuff to cover. I'm going to be your moderator today, and we're going to jump right into it. So, DW, we just had a really interesting discussion from Steve, wide-ranging discussion. The questions I'm going to be asking today are the questions that I'm getting on the road from all of the advisors here. The very top of that list is, the US has really ripped on the AI trade. Is it sustainable?
Yeah, so that is the right question to ask. First of all, good morning, everyone. And let me say an early good morning to folks on the West Coast joining us online. So, central question, right? Equities have been ripping, largely driven by the US, which is kind of always the case, given that the US is the largest market. And the US has been ripping primarily because of the top end of the market, which is AI. So the question is, can that continue? Yep. Is that sustainable? So the way that we try to answer that as asset allocators who are looking at basically every asset class around the world is we're running our process. And you need to be anchored in a disciplined process, asset allocation, equities, fixed income, whatever it is. Because especially when you have something that's new and shiny, yep, like AI, if you don't have a process, if you don't have an anchor, you're basically just telling yourself stories. Yep. And there's some good ones and bad ones, what have you. So, as those of you who have known us for a long time, our process has 4 pillars: macro, bottom up, valuation, and sentiment. And when it comes to the U.S. market and AI in particular, they're kind of mixed, I would say. So the macro is okay. It's not great. It's not terrible. We'll unpack that later in the session. Valuation is extended. Steve was talking about some of his companies being only slightly more expensive than the market, but the market itself is expensive. There's no question. Sentiment, people have gotten relatively bulled up, which is usually a contrarian indicator for us. Folks over their skis, basically positioned for further rally. You tend to want to lean against that. So none of those are particularly constructive, but the one that is very constructive right now is what we call our bottom-up pillar. So this is when we're getting intelligence from our hundreds of underlying portfolio managers, analysts, what have you. We think it's a real source of informational edge for us. And we keep asking them, is this earnings growth sustainable? Yep. As Steve said, stocks follow earnings. Yep. Is this earnings growth at the top end of the market sustainable? And they keep coming back to us and saying, yes, not only is it sustainable, but the market actually may be somewhat conservative about what it's saying with respect to these companies' earning power. And in that context, when the people who know these companies best, because they've been working on them and working with them for years, we're one of the world's largest shareholders in basically all of these companies. When they say earnings are going to be better than people think, we have to be there. So what are we doing in that context as asset allocators? So the first thing that we're doing is making sure that we are on top of those analysts all the time. If they start to tell us, well, people are kind of getting ahead of themselves, earnings may not come through. Once stocks don't follow earnings, or if they do follow them down, we're going to get out. Yep. Not entirely, but we're going to get out. Second thing that we're doing is that we're making sure folks that we have our money with people who are going to be able to navigate this market well. So we don't want to own the whole thing. We want to be with folks like Mark Schmel, Will Danoff. We just spoke to Steve, who are able to pick the winners out of all of this. And then one of the things we do in the funds is we manage our overall equity exposure by shorting out elements of the US market and others that we don't like. Yep. As much. So we control our overall risk exposure. And then the third thing that we're doing is remaining diversified, which is something we always preach, as everyone knows, which is to say that, you know, selling out of the US market 6 months ago on Liberation Day was a bad idea, as bad as, and being all in on the US market now is a bad idea. Yep. We want to stay diversified. We want to cast a wide net for returns, because the one thing that we know for sure is that we don't know anything for sure.
Right. Exactly.
So we want to make sure that we have all our bases covered.
Yeah. That's a really good place for us to start, right? So I don't think people. sometimes people don't realize being underweight the U.S. doesn't mean we have sold all the U.S., as you rightly point out. And I mean, for me and for all of us, I think as economists, it's been really interesting to factor in that bottom-up intelligence, right? It's critical and oftentimes a good stress test kind of where we're at. DT, I'm going to turn to you. That said, I think we probably all have concerns around the U.S. I've got to be careful knowing where we are, and maybe they're listening. I don't know. But again, kind of talk to us about the concerns around the U.S., and I'm glad that you have to answer this instead of me.
Yeah, no, I definitely appreciate you setting me up for this one. So yeah, in a word, I mean, the U.S., I think, is complicated. And I think there are aspects of the U.S. that we definitely want to participate in, and we talked about AI and the transformational nature of that technology. And I think one thing we really want to be very careful and trying to understand is that transition from the generators of AI to the users of AI. And Steve talked about this, and lots of other portfolio managers are trying to source the sort of holy grail of how that technology moves through the market and how that impacts margins. So as DW mentioned, we want to make sure we have those allocations to the managers that are best able to watch those themes and invest accordingly. And then you move on to the economy more generally. And yeah, I mean, it's sort of a okay-ish economic outlook. So we have a group of researchers in Boston who run very elaborate recession probability models that focus on the US and other economies around the world. And you go through all of those analytics, and even with the absence of official data because of the government shutdown, we can leverage some of our proprietary data sources to make up that gap. And the conclusion there is that the recession probability in the US is still fairly modest, and you're getting a little bit in the way of Federal Reserve easing, rightly or wrongly. We can certainly debate that. So that's at least a step in the positive direction. You're going to get a lot more fiscal stimulus with the one beautiful big bill coming into effect early next year. So that's part of a reasonable story for the U.S. And you can look at the labor market, and the labor market, I mean, it's slowed to some extent. And the best way I think that we can characterize it is sort of a low hire but low fire market. So it had been very tight previously. It's sort of coming into a notion of equilibrium. But again, it's all consistent with an economy that's reasonably well entrenched. But then you get to the more complicated part, and we'll all have very strong opinions on this in particular. It's really just what we're seeing from the administration in terms of the policy backdrop. And this, from my perspective, is really relevant as a foreign investor coming into the US, because all of the policy announcements that we have seen, I think one way or another, are really just trying to change the relationship that the United States has with its trading partners, with other countries, with other economies, but also changing the relationship the US has with the global financial system. And we can point to challenges to Fed credibility. We can point to challenges to the provision of economic data. We can talk about trade policy. We can talk about financial flows policy. All of this is really just trying to isolate the US economy, and that has some really strong implications. And the implication that we're most sensitive to is the depreciation in the US dollar. So we can tell lots of good stories about the local currency of the US and what's happening within the US, but as a Canadian investor, being aware of that weakening in the US dollar is really something that we want to take on board. And I think it's a very deliberate part on the part of the administration to try to weaken the US dollar. Part of it is, at least nominally, to bring back manufacturing and revive that part of the US, and it's really debatable whether that will be effective. But a more, I think, insidious motivation is really just to get out from under their debt bubble. And we've seen a lot of federal debt within the United States, and they've also have a lot of foreign bondholders. So one way you can punish those investors is just to pay that back in depreciated dollars. So one way or another, I think the direction of the US dollar is lower. So one of the ways that we want to tilt our portfolios to manage that is to, where we can, take currency neutral versions of our US exposures, but also really tilt the portfolio out of US dollars into other currencies. And this was something we did in tremendous size over the course of the year. So I think in our global balanced managed portfolio, we started the year with a 20% overweight to US dollars. And within the first couple of months of the year, we basically took that to zero and are now underweight. So for us, that's a huge movement of funds that really reflects the evolution of what we're seeing on the currency.
Yeah. I'm going to jump around a little bit. Sorry, guys. I really want to dig into this politicalization of the Federal Reserve, right? I want us to be extremely clear for the people in the room. I view this as a very, very serious risk. We all spent, those 20 years of combined experience working at central banks between us. DW, how are you thinking about this? Is this an overblown risk? And what I would say there is, I think people are forgiving of a lot of things when the line is going up, right? So how do you think about this?
Yeah, so I think this is the at least from a macro point of view, the number one thing to be worried about. Because the Fed, to some degree, is the financial bulwark, in a sense, against less responsible, we'll call it that, U.S. fiscal policy and such. So I think the biggest question, again, macro question that folks have to answer with respect to the U.S. financial markets is the administration going to succeed in taking control of the Federal Reserve? And everything that comes with that in terms of saying, okay, you're going to make rates much lower because that helps us
that's a remarkable
finance.
Sentence, right? To everyone in this room. And
the likelihood, at least in my personal judgment, is that probably happens, at least explicitly or implicitly over the next, call it a year, 18 months, what have you. And I wish that wasn't the case, but structurally it's difficult. I'll get into the weeds just a little bit with respect to the Fed. So you hear on the news replacing Jay Powell, et cetera. It's actually very difficult structurally to turn over the Fed. So Fed governors have 14-year terms, which are particularly designed to stay away from the political cycle and give that entrenchment. They turn over very slowly. And even the ones in Washington that are part of the Board of Governors, most of the Federal Open Markets Committee, or at least about half of it, is the regional Reserve Bank presidents that have nothing to do with Washington, D.C. So turning that over is very hard. You can replace the chairman, and his term is up next May. But even that's not the end of Jay Powell's governor term. He'll still be on the board. He just won't be the chairman anymore. However, we have seen that this administration has not necessarily not even sure how to put this. I'll leave that unsaid and just say, legally and structurally speaking, it's very difficult to do. But functionally, and maybe that's where the rubber meets the road, I think there is a move towards a greater politicization of the Federal Reserve. And we should all worry about that in terms of, to put in context, in the context of some of what DT was talking about. If you really wanted to trash a currency, what you do is you take over the central bank, you cut rates to zero, you treat creditors very poorly, and that makes them sell your currency.
Right, exactly. So, one of the things we've talked about in the office is this concept of observational equivalence, right? And I think they haven't told us they have a weak dollar policy, but it sure is observationally equivalent to a weak dollar policy.
And actually, so you had an interesting experience recently or earlier this week with respect to that politicization of the Fed.
No, exactly. I'm like, wait a minute, I'm the moderator. So I was at a conference. I actually flew here from Philadelphia directly, where I was at the National Association for Business Economics annual meeting that I helped to organize. It's like, the best way to describe it is sort of a collection of nerds. And I'm on the board of the nerds. On Tuesday, I actually had a chance to have lunch with Chair Powell. And again, the discussion with him was incredibly interesting. But even more interesting was the final panel of that conference was 3 ex-Fed regional presidents. And they made it, and gloves came off, right? And they made it abundantly clear just how dangerous kind of the political capture, which is the term they used, of the Federal Reserve is, right? So I think that's an important thing for us to stress here. I'll sometimes say, when I'm meeting with clients, I'll say, you can have your own, everyone is entitled to their own opinion, but your opinion might be wrong, right? And on this, it's unquestionably dangerous. Okay.
Did Jay have any security around him?
Oh, that's right. Yeah, so Jay Powell had, I would say, 4 times the amount of security he had than last year. You know, and yeah, it was. And these were huge human beings, right? Like their necks were like that big. Okay, so I just keep thinking 5,000 people are watching. So okay, we have other things to get to. We're going to circle back on rates in a little bit, but let's talk about Canada, right? So we, for a very, very long time, predating me really on the team, we had this underweight to Canadian equities, which was absolutely the right decision. That's evolved quite a bit. DT talked about the evolution of the Canadian dollar, which we're going to circle back to. But DW, talk to us about where we are now in terms of Canada and where we think we might be heading.
Yeah, absolutely. So first of all, we can put our Canada positioning and our covering of the underweight partly in the context of what we talked about in the
Absolutely.
US. So
Yep.
everything is relative if you're an asset allocator. And so if the US looks less attractive, particularly on a currency basis, everything else looks more attractive, including Canada. But I think there are reasons to be buying into Canada. So what we did just very functionally was when I came to Fidelity in 2013 and the way that things were headed in Canada, we sold a lot of Canadian dollars. And recently, as DT mentioned, we bought them back. So the trade we basically did for investors over a decade was we sold Canadian dollars at par to the US and bought them back at 70 cents. So that's been a very good trade for our investors. And we bought them back again partly because the US side doesn't look as good. But I am getting, and it may shock a lot of folks in the audience that have known us for some time, increasingly bullish on Canada. And that seems strange to say given that things are pretty terrible now. We know that GDP is contracting, the labor market's flat on its back, the housing market is very weak. But that is a function of things that have happened years ago, right? And I think there's been a lot of economic and financial mismanagement. Policy has not been favorable to the economy, to earnings growth, to overall growth, what have you. There is now a view towards that getting better.
Yeah.
Right? And that has to do partly with the change of leadership in Ottawa. And as you know, as many folks know, I worked for the Prime Minister when he was Governor of the Bank of Canada for a number of years. And he has it, he's up against it. There are a lot of challenges, but he gets more than anybody else in the country the productivity challenges and the fact that we've been going backwards in terms of needed investment in a lot of ways. And he's going to try to do better. We'll see if he can, but there's a path at least to it getting better.
Right. Yeah, I mean, in Canada, I used to call it productivity growth, but it hasn't grown, so I just call it productivity now. It's kind of depressing. But DT, turning to, I want to get your comments on this because, I mean, have we just have all of those long-term structural issues that we have and those concerns that we've had in Canada, have those disappeared? And how are you thinking about things?
Yeah, they definitely haven't disappeared, and I think to channel my inner Mark Schmale, one of his famous lines is, when something is bad but getting less bad is a great time to invest. So it doesn't have to be objectively good. It just seems like we're beginning to turn a corner in this respect. So we talked a bit about productivity, and I think you're getting some positive signs, at least the words coming out of Ottawa. We'll see the budget in November, where some of those words will be accompanied by numbers, so we'll be better able to gauge that. But some of the other longstanding themes when we talk about housing and the challenges facing the consumer, so we are still that pig working our way through the python in terms of large mortgage resets compared to 2021 post-pandemic lows in interest rates, but we are slowly getting through that. So again, to really extend the baseball analogy, we're not in early innings. We're getting towards the end of the game there. So that is a sign of at least providing a little bit of maybe not a tailwind, but less of a headwind.
Right.
And I think that's something that is very encouraging. And also on top of that, just when you're thinking about trade policy, and again, we're renegotiating CUSMA or USMCA, however you want to order the countries in that trade agreement. But I think we're maybe a little bit closer to being out of the woods there with respect to not facing the same kind of uncertainty that we had back around Liberation Day, because that was truly terrifying. You effectively shut down the border, and that more or less caused that GDP report that was exceptionally ugly. So not to say we're entirely free and clear from any of this, but there is this movement that's taking place. And I think it's not just us looking at it, but there's definitely a sense that others around the world are seeing some of these changes and starting to view Canada in a more favorable light as well. I think, DW, you were recently in New York, and I think you had an interesting anecdote as to how the world's viewing Canada compared to the past.
Yeah, so I was in New York City last week at a conference, and this is a conference that brings together U.S. investors and Canadian issuers. So that's companies, but it's also the provinces were there, and some of our pension fund counterparts, et cetera. And it was better attended than anything I've seen, and I've been going to this conference for many, many years. There were the room of U.S. investors was fuller than it has been in the past, and the list of Canadian issuers wanted to get in front of those U.S. investors, knowing that higher demand was there, was also more significant. So Canada, again, there's a push-pull. There's the pull of Canada has a path to being better in a way that hasn't been true for a decade. But there's also the push, which is the U.S. has a path to being worse, which hasn't been true in a while. So it's coming together.
And weren't you also bumped off the agenda because they didn't want the economic backdrop? They really wanted to hear from the people issuing
Yeah, thanks
that?
for mentioning that.
So it's interesting. I think, continuing with the baseball analogy, you really want to skate to where the puck is going, right? So
He's not into sports.
No, they're the sports guys.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to FidelityConnects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Okay, a couple other topics I want to get to. Everyone in this room has clients that are incredibly sensitive to rates. So DW, take us through how you're thinking about the rate dynamics, not just the Bank of Canada overnight rate or the Fed rate, but also kind of further out the curve. And then DT, warning, I'm going to ask you what this means for fixed income.
Yeah, so I'll talk about rates and maybe spare you all. I'll talk a little bit about the longer end of the curve and fixed income more generally. So it's complicated in the sense that, so usually when you're thinking about the Fed or the Bank of Canada, you're crafting a fixed income strategy on top of that, you say, okay, what is growth going to look like? What is inflation going to look like? What does that make the appropriate level of interest rates, which is what the Fed and the bank are establishing? And then how does that cascade out the curve? What is the shape of the curve? What does that mean for spreads?
Yep.
And then you construct a fixed income strategy based on that. That's all still true, and we can talk about that. But at this point, as we've kind of alluded to, there's sort of there's an overlay that you have to do that with. It has nothing to do with economics, which is what is the probability that the administration effectively takes over the Fed? How much are they going to drive rates down? How much is the longer end of the curve going to be unhappy about the inflationary consequences? And at what point does the Treasury have the Fed just start buying those long-term bonds to control the yield curve? That has huge consequences for fixed income, and that's a completely different, I mean, a year ago you would have said, well, you don't have to think about any of that, but now you have to think about all of that. So what we're doing in that context is we're being very careful with our fixed income allocations. Yep. One thing we're not doing is buying U.S. Treasuries. So if you invest in U.S. Treasuries, you are a creditor of the U.S. government. And if what the U.S. government is doing is not creditor friendly by moving towards currency debasement, we don't want to lend them money. Sure. So there are plenty of fixed income opportunities, and we have underlying managers. Mike Plage will be up here, I think, later today or tomorrow, who will talk about what he's doing specifically in that fixed income fund. But as asset allocators, our direct holdings of U.S. Treasuries have gone to zero.
Wow. It's just remarkable to me how different our conversation is today versus a year ago. Okay, DT. As asset allocators, we can't be, we've talked a lot about a lot of scary things, but as asset allocators, we can't be defensive everywhere, right? So let's talk about some opportunities. Where are you guys finding opportunities? What are we leaning into? And how are you thinking about some of those asset classes?
Yeah, I'll make a quick comment first on the equity side, then maybe a little bit on the bond side of the portfolio. So on equities, again, that underweight to the US is very nuanced and largely being an underweight to small cap. And then that helps to fund an overweight we have into Europe and international markets, as well as into emerging markets. And it's not that we expect heroic growth out of Europe by any stretch, but there is a compelling valuation argument. And there's also, a potential catalyst in terms of the galvanization that we've seen with respect to regions in Europe maybe playing nicer than they have previously. You've got a certain amount of commitment for a lot of fiscal spending, and that will start to propagate hopefully through other countries as well. So, there is some sense that this is a moment where a lot of countries in Europe have recognized challenges and are now trying to at least bring that into more direct spending. And to that point, one of the theses that we want to really test, and one element of that thesis, is just seeing how much is spreading. So I'm actually heading to Europe in early November, one of these 5 days, 5 countries type experiences, so I'm already looking forward to the jet lag. But ultimately, just getting a sense from people on the ground, I mean, we've heard these announcements, but what's the actual follow-through? So that's part of the overweight we have with respect to Europe. The same is true to a certain degree of emerging markets as well. And then quickly on the bond side of the portfolio, I mean, being underweight or short duration allows us to be more overweight credit and plus sectors. So we work with our underlying managers. We like the attributes of emerging market debt, particularly in local currency terms. It's a nice yield pickup, and it correlates nicely with Canadian dollars, and it gets us out of US dollars. But as well, just working with those managers to just try to enhance the yield side of the portfolio while we're a little more cautious when it comes to investment grade bonds.
Right. Really speaks to the two ways to win. But gold has also been an important position for us. So I've got to ask about that. I get questions about gold now in every single meeting I've been doing, and I don't have to answer it today, so over to you.
Thanks. Yeah, gold. So we have owned a lot of gold in our balance funds for quite some time, thinking of it as a diversifier and as something of a hedge against exactly the kind of environment that's emerging now. So I believe in the funds that we're responsible for as a whole. We own about 9.5 tons. And actually, if you come by the office, we have it in the corner piled up. I'm kidding, we don't do that. No, we take our exposure through the ETF.
It's in my teeth, actually.
You do have a large smile, actually. But no, gold, and obviously gold has been ripping. And the reason that gold has been ripping is exactly what we've talked about in terms of fears of US dollar debasement. And if you're not in US dollars, you have to be in something else. And yeah, you can buy euros, you can buy yen, but there are some issues that way. But gold, for thousands of years has been the store of value. And supply is at least relatively fixed in the short term. So it doesn't take too many individuals and too many of these big central banks to say, you know what? I don't want 80% of my foreign reserves in US dollars. I want 75 or 70 or 60 or whatever it is to really move the gold price. And that's something that can have an awful lot of momentum.
Yeah.
And we've seen that. So we haven't sold our gold holdings. It's still a great diversifier. It's been contributing to performance in the fund, and we're still there.
Right.
And I think another reason, and this goes back to one of your favorite topics, Ilan, is just I still think there's some residual risk to higher inflation.
I was hoping you were going to talk about it.
Yeah, there you go. So maybe I preempted one of your questions.
Go for it. No, please.
No, absolutely. So I think with the tariff risks that are still, I think they flare up periodically in the eye of the market, but the economic impact I still think is coming. So if you kind of pore over details of producer price reports or consumer prices, there is some sense that I think we're not out of the woods yet there as well. And the tolerance of higher inflation, especially if you get more political pressure on the Fed, I think is entirely consistent with another way that the U.S. can punish its creditors by basically tolerating and accepting a higher level of inflation. What you're paying back those creditors are depreciated dollars in real terms. So just as a risk that exists out there that I think the market has more or less moved on from, we still want to provide that protection, especially in the context of a balanced fund.
Yeah, and so that's exactly right. And there's kind of an interesting way that a lot of these themes come together with respect to the U.S. government's holdings of gold. So as I said, our funds own about 10 tons worth. The U.S. government owns about 3,000 tons worth of gold. It's in Fort Knox. It's at the Federal Reserve Bank of New York, et cetera. Does anybody know, actually, in this room, at what price the U.S. government has its gold marked? Anyone? Yell it out if you know. $42 an ounce.
That's a buy. That's a buy.
So it is marked at 42 because that's the price that it was in 1973 when the U.S. dollar got off of Bretton Woods, and it's never been revalued since. It is not impossible that the Treasury could say, okay, we're going to mark that to market. And obviously going from $42 to $4,000 an ounce, and you can do the math times 3,000 tons, that's about $1 trillion. Just with a stroke of the pen could say, oh, we have $1 trillion more liquidity and we can go spend stuff and we don't have to borrow and et cetera. To your point, that's obviously hugely inflationary, and that's frankly more of a monetary policy thing than a fiscal, but that's all blurring. So anyway, you worry about these things happening, and global investors, including ourselves, worry about these things happening, and that's why you want to buy things that are not vulnerable to these kinds of policies that may lead to debasement.
Absolutely. That's a hell of a pen to have with one stroke. Okay, we're going to move. We're going to move to a separate chunk of this discussion and kind of do a rapid fire round. Now, for many of you in the audience who've spoken to me or any of us, you know we're not overly rapid fire, so we'll be as rapid as possible. If you're interested in a lot of these topics we've talked about, we just put out a paper a couple weeks ago. Our Q4 Thought Leadership paper covers all of this. Please read it and steal from it. But let's get into a little bit more of the sort of casual questions. Oh, there's the paper in the QR code. I want to ask about influences. I think this is a really, really interesting question. We haven't told each other the answers to this, so this is fresh for me as well. DW, talk to me about some of the people who have influenced you.
Right. So I'm happy to do that, and it's not going to be rapid fire because there are a few people who
We're never rapid fire.
Yeah, I'm never rapid fire. Everybody knows that. Self-awareness is important, right? So let me speak about a couple of folks who have really influenced me a lot. The first, going way back, is my grandfather. Yep. With respect to what we do. So he was a really interesting guy. He fled Germany in the 1930s, ended up in New York City, worked a lot of odd jobs, tea factory, that sort of thing, ended up opening up a small butcher shop in Queens, New York. But he, really smart guy, very little education, and was fascinated by the stock market, and opened up an account at what was then a small brokerage called Merrill Lynch in New York City, and would put, say $5 and put it in there and watch all the stocks and everything. My grandmother thought he was crazy because, from that generation, like if you save money, you put it in the mattress or maybe you trust a bank. Sure. You certainly don't buy a stock, et cetera. But my grandfather loved it, and he loved it his whole life. I used to go visit him when he was much older. He passed away a few years ago, but even into his 90s, I'd go visit him at the retirement home. He would have CNBC on. Oh. So I kind of got the bug earlier on. The other person I'd mention who was really quite an influence on what I do and how I do it is Mark Carney.
Sure, I've heard of him.
Yeah, so I've known Mark almost 25 years. He brought me to the Bank of Canada when he became governor in 2008. I worked for him as his advisor until he left for the Bank of England in 2013. And he was an influence on me actually in a kind of different way than you might think. Mm-hmm. So it was nothing about economics or policy or financial markets. He actually had a big impact on me with respect to work ethic. Mm-hmm. And so let me talk about. Can I talk about that?
Yeah, of course.
Okay.
Yeah.
So
this is the second part of the rapid fire.
Yeah. Okay. Or the eighth. So. I was, early in my career and in school, I was a pretty smart guy and kind of leaned a little bit too much on that and wasn't always the most industrious person. So I got to the bank, I'm working with Mark, and what I saw in him was not only very clearly the smartest guy at the bank, but also the hardest working guy at the bank. Tell a little story about that. So we used to go and represent Canada at all these international meetings, BIS, IMF, OECD, G20, all of this kind of thing. And before these meetings, a couple of days before, we would have a briefing from the staff who were basically, all right, you're going to be negotiating with other countries on these 20 topics, and here's our guidance. And we would get these briefing books to read beforehand, and these things were hundreds of pages, huge, sometimes more than one binder. And so we'd go to the briefing, and I remember this one actually quite clearly. We were going to the BIS, so Basel, talk about banking regulation, and we're sitting around, and the staff is briefing us, and Mark says, oh, but your suggestion on which policy to support in this contradicts what I read on page 267 of the briefing book, which says that we should be supporting this other policy. And I'm sitting there thinking, like, you got to page 260. Maybe I did, but I was half asleep when I did it. And so here's the governor who has, obviously just the largest set of responsibilities you can imagine. And he's not only reading through all the briefing books and not relying on the staff, but he's going toe-to-toe with the poor staff whose whole life may be this little, piece of policy. And the governor is like, well, explain. But it really impressed me that someone who is that capable and that smart was also the hardest working guy around. Yep. And it, in a sense, it kind of shamed me to say, you know what, I can do better, and I've tried to do better.
Yeah, interesting. DT, that's certainly my experience working at the bank. I was the guy sweating it out, preparing the 300-page binder, as was DT. DT, talk to me about some of your influences. Yeah, or how you think about that.
Yeah, I think it's really important to have people that you can rely on as mentors in your career. And when I started at Fidelity, I was an economist, a strategist by training, but I'd never really managed money before. And I did take stock of a lot of other people who had similar career trajectory, and it never really ended well because the graveyard of economists turned money managers is very large, because you can get the macro right, which is really hard, but doesn't mean you get the trade right or the investment right. So having a chance to really work with our former CIO, Jeff Stein, a lot of the senior portfolio managers, just allowed me to become a little bit more ingrained in the money management process. And it was a nice, slow, gradual adjustment that has led me to where I am today. But the deeper point, I think, and this is something I think is really important, is to find mentors. So if you're more junior in this career, find someone who's more senior, who's had the experience to just walk you through their learnings. And for those people that have had more tenure, this is your chance to give back. And it's really, I think, important to try to provide those opportunities for the next generation. So I think that's a really important part that's helped my career. I think it's helped all of us along the way. And it's something that I think a lot of people can channel as well.
Yeah, absolutely. For me, you need those selfless mentors and managers early on that really help you, right? So, I've had that. I've had that in every job I've had, Bank of Canada, Bloomberg, Fidelity. When I think about mentors, I kind of think about my dad and my father-in-law. My dad immigrated to Canada in 1971. Again, immigrant school of parenting, like he used to tell me, shoot for the stars and be happy when you hit the tree. Right? So that was one of his lines. He told me the only way I'm going to pass high school is in a cab. He had his full of these good lines. But and then my father-in-law, who's 83, I can repeat none of his lines on stage because the head of HR is right over there. And but he has helped me through every salary negotiation, every review, every move from Ottawa to Boston to Toronto. So it's been kind of incredible. Okay, last question I want to ask is, what your average day looks like, or what does the day look like? DW, I'm going to start with you. Go.
Yeah, I'll be quick about this one. So our day starts with what we call attribution. So wake up in the morning early, big cup of black coffee, open the computer, and we get a 65-page report. It's actually the full report is hundreds of pages, it's 65 summary in gory detail of our performance and every decision that every one of our managers made and their contribution to performance, absolute and relative. And I do that, one, because it's our scorecard, and we're here to win. We want to win. We want to beat benchmark. We want to beat peers. We want to beat the market. That's what our job is on behalf of clients. But also, it's a great test of risk. So we have all these risk models that tell us we're exposed to this, that, and the other thing. But they're models, and you all have heard me talk about model suspicion. There's nothing to replace live performance and behavior to say, okay, what are we really exposed to? And it's usually a clue to say, well, maybe you have a little too much of this or a little too little of that, and we'll make adjustments. So it's a great way to go forward in the day to start there.
Absolutely. DT.
Yep. I do what he does. One of the other things we do, I mean, as you heard from Steve, we have just tremendous resources available for us, and it's just absorbing information. So the lion's share of my day is just literally pulling in together all the insights. I know Neil Constable will be up next talking a bit about how AI is helping us. So that's basically the totality of our days, is absorbing information to make good decisions.
Mm-hmm. And for me, I mean, we're almost out of time, but for me, day before yesterday, I flew here from Philadelphia. It was my 76th flight of the year. So my day normally starts either in a hotel or going to Pearson. I've met a lot of you in the room. If I haven't met you at this point, it's kind of odd. A fun fact, a couple weeks ago I was in Ajax, Ontario. I mean, I don't mean to brag. And then I mentioned this was my 68th flight of the year, or whatever it was, or I was at 70 at that point, and an advisor asked, "Oh my God, that's a lot of travel. Are you married?" And I said, my answer was, "We'll see." Right? So I was when I left this morning. It's been a great treat for all of us talking to all of you. Thank you again for the support. We have a 10-minute break, after which Neil Constable and Ramona are up. So thank you again for your time.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.